Today, I want to talk to you about two of the most interesting Canadian oil and gas stocks. On the one side, I've got Strathcona Resources. On the other, I've got Cenovus Energy. These guys are super interesting to me right now because just this week, they have finally finished the story of Meg Energy. Cenovus is going to walk away owning that company. They did have to increase their offer, and Strathcona snuck out with a serious cash pile and some key assets from Cenovus, which means that each of these companies has sort of set their direction, and that has told us an awful lot about the direction of the industry. So we're going to talk about what this means for the Canadian oil and gas industry. We're going to talk about what each of these companies gets out of this deal, where it's going to put them in the future, and what their future profitability is going to look like. And we're going to talk obviously about where my money's going. You know, how do I see this impacting stocks that I own? And am I going to then buy one of these two companies? Now, obviously, we got to start by talking about what ended this long saga, because we've seen this sort of, maybe this is it, happen a couple times. And the final ending was a deal reached between these two companies. Cenovus probably was pushed by Strathcona. Obviously they've agreed to this, but they were pushed to increase their offer, and they sold some assets to Strathcona at sweetheart pricing. So the offer finally ended up at $30 a share per share of Meg Energy, which was about $1.50 above what they originally offered, which was I think 28.5. They had increased it to 29.5. We thought that was maybe going to be enough a couple of months ago now. But finally, final story here, $30 a share. But I think this is probably more interesting. At least many of the investors that I've been talking to about this over the last couple of hours as I film this have been way more interested in this. They also sold some Vaughan thermal heavy oil operations and undeveloped land in Western Saskatchewan and Alberta to Strathcona for $150 million. And while $150 million is the headline price on that deal, it's actually a $75 million payment up front, or at least on closing, and then followed by a $75 million payment conditional upon the asset or commodity prices. That's something that's really interesting to me. And don't take this as gospel, but I've seen some folks out there that have been trying to put together the math on what are these assets worth? They've said that this is going to be, not only immediately accretive to Strathcona, but these assets are going to pay for themselves within 2 years, which is huge. If you think about how long it usually takes a return on capital on a huge investment in this space, at a time when we're looking at 60 something dollar WTI, right? Low 60s. We've had it in the 50s in the last couple of weeks, right? Seeing a 2-year time frame to pay off these assets is massive. Now, obviously, there are some bigger stories here, but I think the biggest one that this story has told us about the Canadian oil and gas industry and about all the stocks in this space is that single play companies that focus on what they do best, on their core competency, that is the move right now. And we've seen that sort of story echoed many, many times over the last year. We saw it echoed when Strathcona sold off their cacao assets, right? And they focus on becoming a heavy oil company. This acquisition fits that, right? They didn't just go out and acquire whatever Cenovus had. They found something that fit into their portfolio. And they've reinforced that story over the last little bit. They said, hey, look, Meg is going to fit into our portfolio in this sense. Maybe that didn't work out the way they necessarily wanted, but they still got assets that fit their portfolio. They still refined their focus of the company. They're going to return a huge amount of capital to shareholders. And they talk about their own organic growth. Adam Watrous will be the first guy to tell you that that company is growing organically at a fast rate. They would say they're the fastest growing of companies their size. On the other hand, now we've got Cenovus Energy, which is clearly also focused on what they do best, on being this oil sands giant. We saw earlier in the year, there was some sales of downstream assets, which obviously have been a massive weight around the neck of this company. It's been slowing the stock down. If you look at the way the stock performed this year, we saw Cenovus not necessarily enter 2025 as a laggard, but definitely lag at the start of 25. We were talking about them as the most sort of underpriced, not necessarily undervalued, but the cheapest priced Canadian oil and gas major out there. And while sure, they're maybe not a major in the sense that IMO and SU are, right? They were of the sort of big four oil sands companies out there. They struggled a lot. But as the year rolled on and we saw, first it was their move to acquire MEG and then their move to get rid of those downstream assets. And you saw the sort of the movement going towards them clearly consolidating their focus on here. This is what we do best. We're going to focus on it. We're going to be as ruthlessly efficient as possible. We saw the stock price materially improve. And I think that reflects the fact that investors are incredibly confident in what Cenovus has coming. On that topic, given that they're the bigger of the two companies, I do want to start by talking about what their future plan is going to look like. And I think we saw a big part of this back when they made that M&A announcement in August, which is their acquisition of Meg Energy announcement and showing what exactly they're going to do. And obviously, they say a lot of things that echo what I believe is happening universally across the industry, right? Increased scale in SAGD oil sands, or SAGD as it should be pronounced. That increased scale is going to help bring their profitability, bring up their reserve life, bring down the price per barrel of oil. There's a lot of really good things. Obviously, the assets fit really well. They literally had the one half of Christina Lake. Now they have the other. We saw folks talk about the fact that now, you can drill right on what was once the property line. Like, that's not a problem anymore. Cenovus, they'll detail this later in their announcement here. They have actual ability, sort of technical ability they think is better than what Meg was doing. I'm not an engineer. You can argue that yourself. But they also talk about $400 million in annual synergies, which I think is huge. $400 million in synergies is massive. And well, I'm sure the first thing that most investors thought when they saw 400 million was like, oh, sure, please. If you look at what happened with Whitecap and Varen, everybody back in December 24 was like, oh, come on. You think they're going to make that much? That whole winter when that first deal between Whitecap and Varen went through, there were lots of investors that were totally, on Twitter, on Reddit, on Blossom, on all these sites. They were talking about how they didn't believe that those synergies would realize. They didn't think they would actually be able to make that money. And we've seen in the most recent earnings there from Whitecap that actually it did. It worked out beyond what they expected, right? And I think that sort of idea should give investors an idea of actually this money is going to be immediately accretive, right? And it'll probably show that these guys actually realize that $400 million in synergies within a year, 2 years. And that's going to be huge considering the kind of cycle we're in for oil and gas. You talk about the fact that we're at this cyclical low, right? And that these companies went out and did this, right? Both Strathcona and Cenovus went out and focused their acquisition at a cyclical low for these kind of heavy oil or oil sands assets. Makes a lot of sense to then sort of, become as ruthlessly efficient as possible, working on production in the most efficient way you can without necessarily deploying a huge amount of capital, and then reaping the rewards when you start to see the cycle turn. And while the cycle might take years, it's definitely going to turn. And so from a longer term perspective, it makes a lot of sense for this to be Cenovus's plan. Obviously, they're going to then, the question is then, what does their financial position look like? And they talk about the fact that they're still an investment grade credit rating, which is huge. They still have less than 1 net debt to AFF at strip pricing, which is also huge. So that's not, at current pricing, at today's price, that's at where the strip is right now, which shows, a little bit lower through this winter, sort of back up through the second quarter through to the fourth quarter of 26. So pretty good, if you ask me. I think that's honestly, all of those things look pretty good. Right, there's a couple of things here, right? You talk about, obviously, the numbers are going to be different, right? If you look at all the financials, the numbers paid because they just increased the offer since this came out. But, they're paying a significant amount in cash, right? It's going to be a significant amount in debt, but there also is a significant amount of sort of loan facilities at the company. So they're going to be more or less okay. It's not going to that 50 cents a share isn't going to massively change the metrics here, but you are going to see the same kind of growth. So you're going to see an increase of a significant amount. So 72,000 current production with under 55,000 per in planned production growth, which is good. Obviously, we've shown this on the channel before, but I just love how well these two assets go together. I think that was one of my favorite things about Cenovus's offer back when they came through with this. It is literally they are next door neighbors. If there was anybody who could take advantage of that asset and had the infrastructure literally there, the people could walk across the property line and operate it, it was Cenovus. You talk about the sort of, look, you're going to see a million charts that look like this, right? Oh, we're the best performing. We have this performance metric, right? They're going to talk about the fact that they're going to be producing a huge amount. And as far as SAGD goes, these guys are killing it. They're going to capture a significant amount of value. Obviously, a chunk of that's going to be things like G&A, commercial, and financing The bigger you are, the easier financing is going to be, the cheaper you can sort of keep it, but also a significant amount of operating and development synergies, which is huge. So while they say they're going to achieve about 150 million of that in near term, I think you could see like a significant amount of those operating synergies come online faster, because that's what Whitecap saw, right? They saw a significant amount of those operating synergies work out pretty quick with their Baron acquisition. And obviously there's going to be some serious long-term bonuses for the company. And obviously we talked about things like their pad and well design, right? So basically their technical capabilities, they believe, are best in the industry, and they think that their plan is more efficient and it'll work better. Interested to see. They also talk about redevelopment opportunities, right? So low capital, high return production without additional steam. Really interesting. Obviously, then they have this sort of combined asset. It unlocks boundary resource. They optimize drainage boxes. So basically, if I just had to sum everything up that Cenovus is planning, they are going to be a ruthlessly efficient operator. They're going to try to keep capital costs down right this moment, because obviously they just took on a bunch of debt, but they're going to try to not, they're not going to break the bank working on these synergies or working on whatever sort of redevelopments or operational steps they need to take. And then they're going to benefit a huge amount. They're going to profit by the tune of hundreds of millions of dollars a year in the short run, maybe up to more than $1 billion a year in the long run. And if you think about the price they're paying, right, and you think about, okay, well, obviously metrics are going to be a little bit shifted because of the increased offer. If you're paying 8-9 billion and they're saying they can see 400 million in synergies. If that's the only profit you get out of that deal is those synergies, well, again, the return of capital time is not that insane. And that's at current strip pricing, which obviously we're talking about the fact this is a cyclical low. You should expect to see that materially higher. I'm sure at an $80 barrel, that profitability, extra money you're getting out of those MEG assets that, by the way, we're already generating money for MEG themselves as a company, that's going to be a huge step forwards. The amount of value that you've now added to the company because you've acquired these assets is huge, right? And the amount of scale that you've implemented here and the focus you've done and the fact that you've been able to sort of push the board and the company to sort of cut away some of the less profitable assets, and shareholders really like to see that and they've rewarded them. I think everything's pointing up for Cenovus. I think Cenovus makes a lot of sense. I mean, personally, I'm not buying shares today, tomorrow, right? When a news story hits like this, I usually don't want to buy in that moment. I do want to see where the market settles. I do want to see what the final story is. But I think Cenovus is a high quality, reasonably priced now. They're not as cheap as they were back in the spring. Reasonably priced oil sands producer. They have some significant sort of long-term synergies and opportunities that they're going to try to exploit. And I seriously believe that they're going to be a successful player. I think if you're willing to sit out for this commodity cycle, and again, I don't know if that's going to take 12 months, 18 months, 5 years, but if you're the kind of investor like I am that's willing to sit out and wait, maybe it makes sense in your portfolio. Maybe. But there's a lot of investors on the Strathcona side that are very excited about what this means for them. When we talk about what Strathcona has coming next, we have to sort of piece it together a little bit more, because unlike Cenovus, they don't have a nice infographic to show us with all their plans about their new assets, because that's obviously not the story that played out. But there are a couple of key things that they did announce just a couple of weeks ago here in October when they terminated their bid for Meg Energy. So this isn't, today, this week, when they sort of agreed with Cenovus and Cenovus took the asset. This is a couple of weeks ago when they first were like, yeah, okay, we get it. Cenovus is going to win this thing. Doesn't mean we're voting yes now, but they're going to win. And there's some interesting things. Now, obviously, they had some things to say about Meg Energy and the board there, but they also talked about a special distribution. We actually first heard about this on In the Money by Amber Kanwar back during the Stampede, right? Adam Watrous himself kind of announced this, and everyone was like, whoa. And if you're on Twitter or Blossom that day, right? Any of these sort of investment spaces, people were like, what? Talking about a $10 a share special distribution. That's a significant amount of money. That's going to go to all Strathcona common shareholders. It's expected to be completed as part of a statutory plan of arrangement that entitles them to receive the special distribution as a dividend or as a return of capital. So depending on what's better for your portfolio, right? If you're in a registered account or not, right? You can get it the way you want it. I think that's awesome for a lot of shareholders. That's going to be paid in connection with the reorganization of their business into a pure play heavy oil company and the discontinuance of its Montney business. So this is basically them paying you the money they got from that asset sale back when they first started this deal, which of course was those cacao assets, their Montney business. And of course, that's going to be huge, right? There's going to be a meeting of shareholders on November 27th, where it's going to be approved by at least 2/3 of a vote. Obviously, the Waterous Energy Fund owns a significant amount. They are going to vote in favor. So, because I mean, if it's Adam Waterous at the head of both of these, so why wouldn't they? So it's going to be like a significant amount of cash. And here's the interesting part, because if there's one thing Strathcona does really well, it's talking about their benefits to shareholders. These guys definitely are like a little bit boastful. And I like that, to be honest with you. They're the only pure play oil company in North America producing more than 50,000 barrels a day without mines or refineries. It took me a second there. An updated corporate presentation has been posted on their website, which provides further details on their go-forward strategy and long-range plan, and I encourage you to check that out. They remain committed to their previously disclosed long-range plan of organic growth for 120,000 to 195,000 by 2031, which is a 10% compound annual growth rate. So they're not kidding. They do plan on being the fastest growing, and their plan is just to organically grow. And again, if you think about the fact that we're in a cyclical low in the oil business, that makes a lot of sense. A lot of players like Cenovus and honestly like Strathcona earlier this year are looking to secure assets now. But if that option is off the table, the next best thing would be to simply continue to grow within the assets you own. They also do have a significant long reserve life. They have a lot of obviously like high margin production, deep inventory of low break-even drilling. 100% of the planned growth is going to come from their SAGD properties. Again, this kind of asset is at a significant discount, in my opinion, and obviously in the opinions of a lot of these companies buying into these assets. They've got some greenfield, they've got some brownfield, so they got some things that are either new developments or sort of redevelop or changing the developments, right, improving them. Majority of their incremental production growth is going to be sold in the U.S. Gulf Coast via their owned and operated Hamlin Rail Terminal and a new long-haul pipeline capacity, which is also huge because the pricing they're going to get out of that is big, right? The sort of position that puts them in is definitely beneficial in a pricing world, right? They're going to get closer to WTI than WCS. That is going to be a benefit to them. Their board of directors have approved a capital budget of $1 billion next year with associated production guidance. And upon this special distribution, they're expected to have approximately $2 billion in net debt, of net marketable securities and more than $1 billion in liquidity, which is a huge excess cash flow above their existing base dividend will be allocated opportunistically between debt repayment, M&A, and further shareholder returns. They're also going to sell WEF, Waterous Energy Fund, is going to sell or pass through some of its transactions to its limited partners in accordance with its plan. And essentially, if I had to make this plan make sense, they're trying to increase liquidity. That was, again, a big part of the MEG deal in the first place. When we first covered this, right, it was, okay, Waterous Energy owns a huge chunk of the shares, right? We talked about the fact that they on their own can make a shareholder vote go yes, which pushes away some institutional money, right? You can't argue that if one guy can decide what happens to this company, as a shareholder, you have an awful lot less control. A lot of shareholders have been willing to take that risk because they trust the guy at the helm. Adam Waterous is a legend in the space. But some shareholders, especially like the bigger institutional ones that maybe have, billions of dollars to play with, that want a little bit more say, maybe they want a board seat, right? If they feel like they can't get that here, that's going to push away institutional money. And that kind of institutional money does make a big difference in the long run. So them selling off more shares, basically distributing them to limited partners is smart. They're gonna be distributing a couple in November and 8% early 26, right? That'll decrease them to about 66.6% or 2/3, right? Which then is an awful lot closer to that margin of not being able to just push through a shareholder vote on their own. No member of them is going to be receiving shares. So it's not like he's like, oh, well, the fund isn't going to own these shares, but Adam Waterous as a person is, right? This is going to go out to other folks, which I think is a lot of a smart move. And so I think Strathcona's plan is pretty clear, but I also think that they're probably not done. And I say this just because if you look at that last chunk of them talking about their planning and you look at the $2 billion in net debt, I'm going to say this, debt net marketable securities and $1 billion in available liquidity, that means that there is definitely the availability or the opportunity for them to go and acquire some more assets that fit their portfolio. I've already seen people like float ideas like Cardinal getting bought by them, right? And people are going to put names out there that are like, oh, maybe this fits the size, but I definitely think they're probably, they got their eyes out there for any heavy oil assets that are available. Obviously, it has been an absolute, like cleanup of basically a lot of the sort of institutionally held or overseas held assets in that space, right? So we've been seeing everyone from pension funds to major American companies selling off those assets. But I think it's definitely still an opportunity for Strathcona. Going to be interesting. And seeing them grow at a 10% CAGR is definitely impressive in the space, especially if you're buying them at a structural low. If you see the stock price kind of relax a little bit once the excitement about that special distribution is over, and then you see, the opportunity to be buying in and to be sort of growing over time, I definitely think as a long-term player, I mean, I personally own a couple of shares. I think these guys are going to perform well in the longer run. And I am interested to see what their next move might be, because they have created a huge amount of value to shareholders. Definitely interested to see how the WEF pass-through goes, right? Like, does this continue down the road as they complete that deal? Does it materially shift sort of the investability of this company, right? And we're going to see that story come out, not necessarily from you or I, right? The retail shareholders. That's going to come from the big wigs, right? You're going to see guys like Cole Smead or Eric Nuttall talk about that story, because those are the guys that exist in that space where they do really care about the corporate governance of a company, and they're not just essentially trusting the board of directors, be it an Adam Watrous at his WEF fund or be it a John McKenzie, right? So it doesn't matter who's at the helm. You got to trust them either way. And so for us, it doesn't really matter. For the institutional guys, it actually matters a lot. We'll see what they say about that story as time plays on. And obviously, we're going to see a couple of hot takes here over the next little bit as these institutional players see this deal finally come to a close. And I'm really interested to see what they see coming up. So with all that being said, I would love to hear your thoughts in the comments down below. Let me know. Do you like where Cenovus is going? Do you like where Strathcona is going? Are you interested in either of those businesses on a go-forward basis? And what would be your time frame? Because I think that's an interesting question for me right now with this sort of settling down is where's the time frame on each of these companies? And does that make sense for you as an investor? Following that, if you like what we do here on the channel, please do like the video. If you like covering these Canadian stories, please do subscribe. And with that being said, I hope I see you in the next one.